Ladies and gentlemen, friends and colleagues, could I ask people to please take their seats again? I hope you've all enjoyed lunch so far. We're now coming down to the business part of today, and I can see everyone is anxiously waiting for our new format for the Melbourne Mining Club, which we're very excited about to have our panel. So members and guests, it's my great pleasure to call to the stage our moderator for today, someone who is well known to most in our room, Hedley Widdup, the Executive Director of Line Selection Group. Please join me in welcoming Hedley.
Ladies and gentlemen, members and guests, it's a great privilege to take the stage of the Melbourne Mining Club, a real privilege in front of such a distinguished audience. And please, will you, as I'm introducing these gentlemen, welcome to the stage what I think you'll find is an all-star panel to discuss mining finance. We've gathered some of the most active mining financiers in the country to talk to you today. I actually don't think they need detailed introductions because you probably already know a great deal about them. So, in no particular order of importance, Aaron Ross, Head of Global Resources, Energy and Infrastructure for the ANZ Bank. Jason Chang, co-founder and CEO of EMR Capital. Last and by no means least, Richard Phillips, co-head of Greenhill Australia and Vice Chairman of Greenhill globally. Now, if you were to do as I did and have a quick social media stalk of these gents, you would probably figure out that between them there's about 79 years of combined experience, which is a very impressive number. Adding me to the mix really only rounds it up to a round number. I think you'll find that unless these guys know about it, it really hasn't happened in mining finance just yet. So the topic we've been invited here to speak about, the future of mining finance, more particularly, is where is the money? The biggest and longest term issue which has always confronted the mining industry, it's not perhaps all that obvious during boom times, but it always exists, is where is the investment going to come from to provide for the development of future sources of production? And it's particularly pertinent at the moment where we speak with the backdrop of one of the longest and deepest busts which has taken place in mining history between 2012 and 2015, which saw a real exodus of investors from the mining space. The development pipeline of future production wasn't just paused, it was absolutely denuded and put on rest. So there are a lot of projects which need to contribute to future production of the mining industry and are just nowhere near as ready as they could have been had that investment pause not taken place. We can see that the market is warming to miners again. Since January 2016, companies like BHP have put on about a 250% performance, which is very impressive. So the top end of town is obviously well loved by investors. At the junior end though, stocks which collectively fall below any of the mining indices have put on a median performance of circa negative 10%. So I think there's a two-speed equity market taking place there. The worry, of course, which that produces is that the equity market has always done a lot of heavy lifting when it comes to investing in the development of new supply, whether it's in a single company or a much more mature company which is putting those projects in. So the question that brings it to is the equity market in some way broken? And what is going to be the source of finance which provides for the future development of these mines? With that as a backdrop, I don't think there's any more a logical place to begin than with an assessment of the current quality of the equity market for miners. So I'm going to start with Richard being the equity expert, if you like, from the panel here. Richard, you observe equity raising trends of miners, and I'm talking about the public and listed equity market. You observe these firsthand. You probably observe the failures which we don't hear about as well as the successes, as well as advising miners on how they go about getting finance. Can you tell us and open up, the big miners might be trading healthily, but can mining companies in the mining space raise equity money at the moment? And if they can, who is it that's going to be most successful doing it? Who can access the market?
Yeah, thanks. I don't think listed equity markets are broken, which was part of the sort of theme we were going to debate today. I don't think listed equity markets are broken. And I think for junior miners, there's still access to equity. You've still got retail investment, you've got high net worth, you've got some institutional money at the smaller end. I think where listed equity markets get a lot harder are really at that mid-cap level, where you've got a really world-class project where you need hundreds of millions of dollars of funding. I think that's where listed equity markets get more difficult. I think we'll see those sorts of businesses increasingly being acquired by larger companies which may be listed or by private companies. You see Hancock with Riversdale. We're acting for Kidman. I managed to time it this morning. We announced the transaction with Wes Farmers to fit in with the lunch. But that's a big balance sheet buying a listed company that needs a very significant amount of capital. And I think that's the area of challenge for the mining sector is that mid-cap. I think the other point I'd make about listed markets, not just a funding point, is the challenges of being a listed entity. And I wonder sometimes, I've been doing this a long time, how much of it's me getting grumpier as I've done it for such a long time, or how much the market's actually got harder. It's probably both. I think as a listed entity, with the governance requirements, with the reputational legal exposures, with short sellers and activism, social media giving access to people to voice views immediately, aren't always well informed. Being a listed entity is itself a difficult thing, and that's true for all size companies, regardless of that equity specific question.
There's quite a bit to chew on there, and I'm glad you mentioned the Kidman transaction. I don't imagine it would have been cheap for the Melbourne Mining Club to delay that to be able to announce this morning. So topical that we can talk about it, and perhaps that stimulates interest for the equity market piece at a time. Before, Jason, the equity market is weak. I'm sure that generates some opportunities for you, but before I give you a chance to comment on that, I wouldn't mind hearing from Aaron. Aaron, you're a lender to miners. When you're lending debt to a company, it's inevitable that the equity market collectively or even singularly is going to be your counterpart in funding something one way or another. So you must have an assessment. Is there anything you can add to Richard's comments there?
Yeah, I would agree with the comment that Richard made around the equity market, how we certainly do not see it as being broken. I think there has certainly been a change in the underlying equity market. From a banker's perspective, I mean, clearly the role of us is actually to sort of fit in between and actually size up the particular size of debt that a particular asset can actually borrow. Obviously, there's different types of debt that can be, whether it's senior mezz or whether you actually go into the convertible bond market or the note market as well to actually help structure a transaction. But ultimately, it's really up to the bank from a debt perspective to really assess the underlying risk of that project, which is very broad. It's not just a financial risk. You actually look at the management, you look at their ability to manage the various issues that sit around sustainability and the social license to operate. And there's other elements to that as well, which you actually look at in a broader sense, including management is obviously incredibly important too. So from a banking perspective, I mean, we certainly are in the market to fund projects and to fund very, very good projects. But I do think because returns, not only within the bank market, but actually the market in general, because of the source, there's so much liquidity out there, returns have actually started to fall, which is making banks more conservative.
Jason, you are managing arguably what is one of the most recently successful and pin-ups in the private equity sector of mining, and I think you probably have a unique view there of whether it is easier to be a listed company or to obtain private finance, albeit a lot of people wouldn't know where to go to obtain private finance. I'm interested in your observation of the equity market because it potentially could be a competitor for you at some stages and at other times provide opportunities.
Look, thanks, Hedley. EMR is very bullish on the mining sector. We are very excited about the opportunities that we are seeing. And over the last decade, our view is that the capital for mining actually has increased, Hedley. It's just that there's been some shifts. Number one, the first shift is global investors are really looking for more mature assets, primarily because development has just taken longer. right? There's been an increase in regulation, so we are seeing a shift in terms of relative proportions of capital, moving more into producing assets, cash flows with development upside. So investors are looking for some downside protection, but still the upside return. I mean, that doesn't mean that development assets, there's no capital. Our view is that good assets will always attract capital, right? The thing is, capital is becoming a more sophisticated. If you look at 10 years ago, the capital for mining is a bit more generalist. They are sort of going through all the different stages. If you've seen the Chinese capital and going to early stage, now they're really very much focused on more mature assets, and that's very symbolic about global capital as well. EMR raises a lot of capital. Most of our capital comes from the US. So there's a good pool of capital from pension money, endowment foundations in the US looking for a home in mining and metals. Again, very similar story there, looking for more mature assets. But we're also seeing emergence of boutique specialist early stage funds. So I think the good news is there's money for everyone. But as a junior company, I think now you need to be a bit more focused on the specialist funds rather than the generalist funds, so to speak. So I think the public markets will always play a very key role in mining, and they'll still, the critical part of mining funding. And for us as a private investor, it's also very important for us. So we think there's a role for all parties. And if you've got a good copper asset, Hedley, it'll always do well in the public markets.
I tend to agree with you. A good asset will get funded one way or another, won't it? Sometimes it's being first to the punch as a funder to be able to do that as well. Topical to the equity market, and I hear what you're saying. There is money which is available. And Richard, going back to your comment, you can fund exploration, and bigger companies with cash flow can seek equity investors without too much worry. But it's that development stage which is really the challenge to bring big licks of money in. I'm wondering if the equity market can become more stimulated or excited through a catalyst, and one way which that could happen could be mergers and acquisitions, which is topical given that Kidman, your client, has announced a deal with Wesfarmers this morning. In the last 6 months, we've seen the two biggest gold miners in the world buy big, and we've seen quite a few major miners putting deals in front of juniors to fund them either through joint ventures or through equity investments. What I'm interested in is, particularly with your perspective, you sit behind the scenes, you must have a finger on the pulse, if you like, of the tempo of M&A inquiry, which we don't see. We read in the papers, Kidman and Wesfarmers this morning, but for every one deal that's announced, there must be 3 or 4 that get talked about and perhaps don't go anywhere. Without giving anything away, can you tell us a little bit about the tempo, maybe over the past few years, and whether it's increasing or decreasing?
Yep. I'll take a step back. When I first started in the industry, I used to think it was the easiest job in the world because we'd go and see a client, we'd have a leapfrog chart and we'd say, you're the 4th largest producer, and if you buy the 7th, you'll be the 2nd largest. And we'd all say, that's the greatest deal ever, let's do that deal.
Did you just change the names from Newmont and Goldcorp to Barrick
so
and Randgold?
Again, without naming names, but it used to be very straightforward. It's really hard to get deals done now, much harder than it used to be. There's been mining's a really entrepreneurial space. You've got to be a real optimist to believe you can find something and find hundreds of $millions to build it. People they're entrepreneurial and dynamic, they like to do things. But probably the last 5+ years, very little has gone on. There's been a lot of introspection, a lot of focus on organic issues. We are now just starting to see the re-emergence of M&A and growth-oriented thinking. Sort of the Randgold, Barrick and Newmont and Goldcorp and all of those things kind of make it safe for people to feel they can go back into the water. But we certainly haven't hit the point where people are banging the table and saying, where's my growth, and you should be buying things. It's still very careful, it's very strategic, and even when things are getting announced, it's much harder to close them. So it's starting to re-emerge. I think things like this morning's announcement, some other recent things that are starting to happen, will make it people feel like they're missing out and they want to be part of it, and people will see some really value-creating deals happening. It's starting to get back on it, but it's nowhere near where it used to be, but I think it's starting to re-emerge.
Let me just simplify that for the journalists. M&A is back on. Everybody should be excited about it. Aaron, you possibly have a slightly different perspective in M&A. the equity market loves to see things get together and create value through share prices going up through acquisitions. As a debt funder, you position yourself differently. I'm just wondering, I mean, you would probably be being approached by people who are considering acquisitions at the same time as you're assessing deals which you're already involved with as a balance sheet participant. How do you feel about M&A and bigger being better from the equity point of view?
Yeah, I mean, from our business perspective, it certainly has been, we've seen a lot of activity in that market, and it's actually meant that because obviously the mining companies are not putting their money into new projects, that's starting to occur now, the M&A market has actually created opportunity for us. Larger acquisitions that have taken place clearly leads to opportunity from a financing perspective. Whether it be a large underwrite being provided to the company being acquired, or whether it be, a large corporate related facility with a group of banks coming together to provide that funding. So we do see from a market perspective, we do see a lot of activity in there. I think the really important thing to really remember though is that for many banks who have considerable relationships with the clients that are getting together, quite often you'll be coming up against internal limits yourself when you're funding these acquisitions, particularly if you're a major funder to the natural resources market such as ANZ that has had a very long history in this market. So therefore you'll need to manage your position, and therefore you might come in and actually help underwrite and fund that transaction, but eventually you'll have to sell down some of your exposure, whether potentially into the banking market or potentially into other markets as well, whether it be the bond market.
You're talking about concentration risk.
Concentration risk, yes.
Moving on from the M&A theme, I think if we cast our minds back 20, 25 years, the most dominant investors in the equity market were the large, call them mutual funds or whatever they were. They were large, they were diverse, they were able to buy and hold, and they could hold for considerable times. They could take fresh equity, and they were prepared to back teams with growth in certain parts of their portfolio. Jason, I think it might have been you, and Richard, you certainly touched on it, that the market has evolved in terms of the equity structure and investors there. And casting my thoughts around, there are hedge funds which have quite a short-term outlook, somewhere between settlement on a placement and 6 months. Might seem like a long time to hold stocks for some of them. There's ETFs which don't buy fresh equity, they're only in the secondary market and can be disruptive when they rebalance themselves. There's royalty and streaming companies which aren't necessarily project builders as much as helping with balance sheet issues of existing miners, depending on how you look at them. And then, of course, there's endowment funds which are happy to put money into private equity, which is probably helping the market to evolve on its own, as opposed to backing some of those mutual funds like perhaps they might have in the past. And what I'm concerned about is at that development level, perhaps that buy and hold attitude may be a way of the past. And whilst there's no shortage of money available to the mining industry, how is it being fed in? And is it coming into a place which is actually going to suit development, or is it more going to suit the growth of large companies? Of course, that'll have an effect for M&A and how things come together. So I'm interested in your opinions, if you like, on the long-term effect of how disruptive that could be from managed investment through to passive. Jason, I'm interested in your perspective, particularly on this, because I think you're a beneficiary of it, but private equity investment was disruptive like this at one stage in mining, and probably still is. And you've commented on the structure of the market. So can you add some thoughts to how this might have changed the way that the equity market is going to invest in miners?
Yep. No, we see the pool of capital has grown over the last 10 years, Hedley. I mean, you talked about the various types of capital, and we see that as a huge positive, right? Because there's going to be something for everyone. I mean, mining capital is becoming more sophisticated, right? So it's not just the short-term hedge funds. Private equity, we are 12-year money, but extendable, so we're not completely short-term. There's a bit of runway. But then you also have pension money that's there to buy and hold. So I think that's a very good thing for mining, because each of the mining participants at different stages of the mining will need different type of investors, right? From an explorer to developer to producer. So we think what it means is that the junior miners or the developers will need to be able to be more sophisticated in targeting the right capital investors, that there's better alignment of interest, right? I mean, so private capital, for example, is fairly new. I mean, you talked about private equity being disruptive. I'm not sure I'll use that word, I mean, at EMR, we come from an operational DNA. I mean, we go in there and work alongside management and prove up and do the operational improvements. And ultimately, we only make money if we make those operational improvements. So we're no different from a mining company, other than we've got a 12-year runway. Right? So we think the mining today is quite different from a decade ago. There's more mining capital, but I think you do need to then look in the right space, for the right type of funding. I mean, when we bought Kestrel not that long ago, we worked with quite a number of banks. 80% of our capital, funding capital, came from Asian banks. So quite a different dynamic today. And so a lot of liquidity for the right assets.
Aaron and Richard, directly after that, you guys have, I think, been involved very much in the front line as participants that haven't really had to change your spots too much, because everyone's always needed debt, everyone's always needed M&A advisory, but you have seen the equity market change over that time. So, Aaron, can you sort of offer a comment, and it doesn't have to be a long one, on how the debt market probably feels about, or from an ANZ point of view, this concentration or stratification, if you like, of the equity market and how it likes to participate? It might be that the equity market is developing debt market-like tendencies and interests towards risk.
Yeah, because it certainly is a trend that we are seeing more PE players coming into the both the equity and the debt markets, and that's been driven because obviously there's been gaps where traditional financiers have not been able to play. But certainly from our perspective, it does actually allow additional capital to come in to make projects successful, and it can actually lead to a fairly good tearing of structures as well. Like I mentioned at the start, whether it be subordinated debt, whether it be MES, or even whether it be convertible bonds, or effectively going into the bond market as well. So it certainly is a complement to us, but at the top end of town, they're clearly competitors, and we've actually seen that certainly play more out in our infrastructure business that we also work on. And that's been a very traditional part of that market, and you're actually now starting to see some of those investors actually moving into the resources market. The reason why that's happening is because they're chasing yield, because they can see an enhanced yield in the resources market.
Are you talking about some of the sort of superannuation style funds who,
effectively, who are carving out a piece of their fund to actually go and focus on driving additional yield?
Richard, I'm going to come to you in a minute, but I'm interested in this point because, there was an article in The Deal, I think it was, where someone interviewed Greg Combe, and he was talking about the size of the industry funds within the Australian superannuation market, which is now monstrous and in itself dwarfs Australian GDP and the Australian Stock Exchange capitalisation, so it's a huge pool of money. Can you stick your hand up in the air if you're in the audience and you're a representative of a superannuation industry fund? I just want to know how well represented these crowds are. I know where he's sitting, I just can't see his hand up. Pretty thin on the ground. I think this is a really interesting source of capital for the mining market, and there's not a heck of a lot of them in the room at the moment. Richard, talking about all those different structures, does this make funding decisions for miners who are coming through the ranks from small to big more complex, or does it make it easier? If there's all those things to go to, presumably some of these products are easy to entertain but possibly expensive, and some of them are harder to get. What's your comment from that point of view?
It's sort of the good news and the bad news. The good news is there's a lot of options. The bad news is there's a lot of options. You've got to try and work out, match the needs of the company and the quality of the project and the geography and the management quality, and there's a range of factors, but fundamentally the quality of the project. You've got to try and work out the needs of the entity seeking the funding with the objectives of the providers, because I think you're generally on a spectrum of, there's some, and you've mentioned some of them, without types of capital, where you can get capital quickly and you can get it with less diligence, but it's going to be really expensive, and if things go badly, they're going to go really badly. They're going to spiral on you. So that's one option, or you can go a much more conventional route where you might be talking to a leading bank or consortium of banks with conventional funding, which is harder. You've got more diligence. It takes longer. It's a very rigorous process, but the outcome can be better. So it depends on where you are in terms of seeking funding, whether you have the sufficient quality and sufficient time to be able to aim for that end of the spectrum and not the other. But I think it's good to have the options. It's still much better to have the options, but it adds complexity trying to work out exactly what the right fit is for given those factors.
I think it comes back to good projects get funded, and it's probably the better money that chases those because that's where they want to be at the end of the day as well. Whilst we're talking about changes in the structure of the equity market, if I again cast back 20 or 25 years, the structure of the mining market has changed quite remarkably in that time as well. There were more and smaller, larger companies, and there were far fewer juniors. In 1996, that was a big year for IPOs onto ASX for mining companies. I think the total was 9. Whereas in 2007, IPOs of new mining companies was more like 175. It was 2 orders of magnitude more in terms of those flows. And over 20 or so years, we've seen consolidation at the top end. So we've ended up with less but larger large mining companies and many, many more juniors right at that bottom level, possibly dabbling in enterprises which are, at the very, very, very risky end for equity. And I just wonder whether this has created a strange paradox of choice for equity investors. I mean, we've talked about their suitability for being listed. We've touched on it. We can certainly go back to that. But I just wonder if, particularly from the point of view of the investors, Jason, you could start with this. When people come to you and say, we've got this opportunity and it's a goldfields-focused gold story, I mean, there's about 50 of those, whereas there used to only be 1 or 2 at the stage which you might be interested. Can we offer a comment on just that diversity of choice at the bottom end?
Yeah, look, from our perspective, we are focused more in getting development returns through producing companies these days, because at the end of the day, the buyer's market have really shifted to more mature production assets. But we're not just buying producing assets for the sake of the cash flow. We really want to buy producing assets with development upside. So we are looking for the development returns these days through producing assets. And hence, we are really not focused on the sort of junior end. Having said that, there's a pool of funding globally that does focus on the junior end, but it does make it more complicated. So, I mean, you've got 50 choices today. You do have to sort of filter through it, and that, for one of those reasons, I think you're going to see more specialization, right? So at EMR, we are focused on 4 commodities. That's copper, gold, potash, and met coal, right? And then you're going to see a lot of specialist funds. So that's why I'm very positive on the world for mining, including juniors, because they're going to be able to tap into investors who are very aligned with them and who know the commodity. So even though you got 50 choices, I think these guys know that commodity extremely well. So I think you're going to get more speed and responsiveness in capital raising, I think. But what juniors will then have to work out is being well prepared and targeting the right audience.
I get the suspicion that quite a few juniors who come to market for funding of any kind are preparing themselves for an equity market style assessment rather than a debt market style assessment, which can be a lot more rigorous. So, Aaron, I might flip to you on this question. I mean, the crux of this question is perhaps, and I think we all agree the equity market is not necessarily broken, but if there is an aspect of it which has changed and produced a challenge, perhaps it's this model of having loads and loads and loads of junior miners as the model, which is the challenge. From an ANZ, from a debt funding point of view, can I get your remarks on how you feel about providing finance to, say, single asset companies versus an established company with a balance sheet? Now, there's an obvious answer, and I don't need you to say I don't like it or I do like it. It's more, tell me about the risk approach.
Yeah, I mean, clearly a diversified company that has multiple assets is easier to bank than a project financing, a single asset-based project. But really, the essence of doing a project financing deal really does come down to the underlying quality of the asset itself, like what we mentioned in the past. I mean, there are a number of transactions that have closed, certainly over the last 2 years, from a pure project financing perspective. And I guess one of the things that we've seen certainly coming through is that the type of capital being provided to those projects is actually starting to look quite different. And the reason for that is probably the underlying nature of that project doesn't meet a number of the risk parameters that sit within the corporate or the general banking market, and therefore they've had to go and source other markets to be able to do that. But then also there's other opportunities such as moving into the export credit market or where you have a facility that's actually funding a project where you have goods coming from a country offshore, and therefore you can actually look to tap in to whether it be that country's export credit company or even Australia's own, for example, EFIC, for example, to help lead that. So there's certainly projects are here to be banked, but I guess from a banking perspective, certainly I believe we have seen a reduction in the amount of risk that banks are prepared to take.
Richard, we're going to, just a couple of minutes warning on questions from the audience, so you haven't thought of one yet, get scribbling. Richard, before we flip to that, and I'm sorry, this isn't a question I had in mind earlier, but I imagine that with majors, as they're casting around to restart their exploration efforts and restock their development pipelines, they're confronted with an industry which is flooded with juniors who have projects, and perhaps they'd like some of them. Do you get the impression that these are being actively pursued, or is it the juniors going to the majors as a last resort of funding?
Well, I'll just comment on the earlier question. From my perspective, there are way too many listed companies and they all should consolidate, and that makes a lot of sense to me. And then we can demerge them and spin it back off. It's going to be terrific.
I'll collect that bottle of wine for setting up like that later. Thank you.
On your point around who's chasing whom, I think the large caps are much, much more prepared and interested to look at junior opportunities than they once were. I think the large caps were generally focused on, back in the day, large cap aggregations and significant synergies and really material transactions. I think we're looking much more at bolt-ons, that is smaller acquisitions, maybe at an asset level, but even farm-ins or cornerstone stakes. You can see BHP and Newcrest doing some of these things. There's a raft of them doing it where you'd say, back in the day, for a company of that scale to be looking at something of that scale, it seemed like a disconnect, but I think people are changing the way they're doing business. So I think big guys, little guys once upon a time would have said, can you help and you should get involved, but I think it's turned a lot, and the big guys are now much more looking for different ways to grow without that big bang aggregation they once would have focused on.
I'm prepared to take some questions from the audience if anyone has some. All right, we've got one. Sam? Can you begin by stating your name and your affiliation, please, as well?
Hi there, Campbell Alder from Morgans Financial. I just wanted to get your thoughts on funding battery mineral projects, given the difficulty in hedging lithium, graphite, etc., and how successful these companies will be in terms of being able to attract debt finance for some of these projects.
Great question. Thank you very much, Campbell. Would anyone like to volunteer? I think you could probably all answer that with fair authority. Richard, you're sighing. Why don't you go first?
I'm sighing because I'm working myself up to answering it. I think the...
This is Mr. Lithium from a deal this morning, right? So he should know all about
hot
this.
Off the press. We've spent a bunch of time with Kidman before we got to this point with Wesfarmers, looking at exactly that question. You've got a world-class asset. It's based in WA. You've got a great site for a refinery in WA, an integrated business with a world-class joint venture partner. Everything's good. So we spent a lot of time working out, well, how do you fund that? If you're remaining independent, how do you fund that? And that question may still arise. The Wesfarmers deal, nothing's done till it's done. And in lithium, it's really difficult because it's such an opaque sector. People really don't know what the pricing is. The first thing banks want to know is how much confidence can I have around the revenue, and you've got to sort out the operational issues, production and so on, but how do I identify that? So we spent a lot of time actually talking to a lot of the end users of the product. Kidman entered into an offtake contract with Tesla, which had a fixed price contract, which allowed banks to then look at a component of the revenue that was production and the revenue that would come from that. We had very productive discussions with LG Chemicals, with Mitsui, where arrangements were entered into as well with fixed or variable prices to try and shore up that reference price to then allow traditional bank funding to come into the mix. But it's a very exciting space. It's an emerging space. Australia is very, very relevant in this space. But it is, you're talking on bespoke negotiations with car manufacturers, battery manufacturers, it's a very opaque and difficult market to navigate. I think we've still got a long way before it really opens up to becoming far more transparent and readily bankable. So we're partway through that process with KIB, and if it remains independent, we'll continue down that path. But yeah, it's a difficult space to fund at the moment.
Only to add a tiny bit to it, perhaps, Aaron, there was a question there about you can't hedge lithium. Now, it's not the only battery. Could you just add something quickly to that perspective on hedging and debt funding of those new...
Yeah.
I mean, the equity market is very excited about these battery things, but it's new and different, and maybe that's the only reason why it's so exciting.
I mean, I completely agree with what Richard just said, but yeah, because the market is very illiquid and there's very little transparency from a commodity perspective. Obviously, hedging is basically you're just impossible to hedge. So therefore, the project financing market becomes very difficult. I completely agree, though. Where we've been focusing on is more the vertical integration and the offtake perspective. The likes of LG Chemical, the likes of Samsung, the likes of Apple, who are looking to vertically integrate their businesses because they're very concerned around where they're going to get the supply, because they can see, obviously, the Asian market coming in and taking up a huge amount of supply, particularly from China. So therefore, if you can focus on funding through utilisation of a higher rated credit from an offtake perspective, and therefore the actual seller may look to effectively give up something as a result, whether it be discounted sales or whether it be equity in the project itself, that would be the approach that we're initially taking to looking at the sector. But it is creating a lot of interest, clearly, not only in ANZ, but obviously a number of banks.
Yep. Thank you for that. I saw Richard Shoddy. Here we go. Name and affiliation, please, sir.
Howard Walker, Lion Selection shareholder. Hedley...
Everyone gets a fortune cookie with a question in it, right? I think Howard's just opened one of those.
Hedley, you mentioned how difficult the cycle was at between 12 and 15, just 4 or so years ago. We're obviously in a new cycle now, and Jason was mentioning that there is good value around, which suggests that we haven't got to the end of the cycle yet. I'd like to ask you and your panel, where are we in the cycle, or should we say the lion clock?
Thank you, Howard. That's an excellent question, and I'm glad you asked. Jason, I'll just give my perspective on this. My personal view is that it was a deep bust. It took a long time, and a lot of investors left the market who wouldn't ordinarily have left the market. They might have held through the equities that they had in previous shorter busts, in which case a recovery is naturally going to take a fair bit longer. But, I mean, Jason, I think you've got some views on the cycle as well.
Well, I think the cycle just started, Hedley, right? It's not going to end. On a serious note, I mean, if you're in certain commodities that, at least for us, we're more familiar with, like, you talk about copper, you talk about gold, you talk about met coal, you talk about potash. There's a lot of longevity. I mean, there's no question around the demand around these commodities. I'm not saying these are the only ones, but these are the ones that we are focused on. And supply is getting harder. We all know that. I mean, it's extremely difficult to get the right quality assets in these sectors. Right? So I think from our perspective, there's a lot more to come. I mean, you can see the capital that's going in. I mean, that's a reflection around the market view. And I think we've talked about good assets being able to raise funding, and it's very, very hard to get a good asset. So I think from EMR's perspective, we are very positive. We are at the moment reviewing no less than 4 sort of near-term opportunities in copper and gold. And how often, when we reflect back, how often since we established EMR that we have 4 near-term copper gold opportunities that we really like. Not that often.
They're pretty rare assets in the world.
Not that often. And Richard's doing the deal of the year. So lots of things going on in lots of commodities. So I think I have to say it is commodity specific, Hedley. It's not one size fits all. So the thematic around commodity selection is very, very key.
I can see the MC gathering at the side here. I think we've got time for one more question from the audience. Is that you, Mitch?
It is, Chairman, thank you. And this is my virgin question at this august body. So just, if you don't mind bearing with me for a tad, I just came back from North America, the United States and Toronto and a few other places. And in terms of the industry's risk appetite and investors' attitudes, I got 5 observations I picked up and my question is, would you comment on them? Some of them you've already addressed. First one is the shift in capital sources. Used to be 80-20. Over the decade, 80-20 in the equities markets, 20% institutions and private equity. It's pretty well symmetrically shifted. Richard Shoddy told me about the substitution racket between mums and dads flow-through share schemes now going to cannabis. It's small beer. It's only really 20% of the source of market. Second one is sources of growth, organic versus inorganic. Nobody's really interested in doing greenfields, mostly brownfields. The operating companies are all focused on project execution. That is what's completely and utterly occupying their attention and their focus. Mergers and acquisitions for growth? No. Mergers and acquisitions for market relevance? Yes. The point you guys made, there's 10, 15 small 150,000 ounce gold producers, not one of them's on the radar. When they start to merge, so the dance card on mergers and acquisitions is all about merging together to get relevance and liquidity and tension in the marketplace. In terms of derating of equities, we're running, 3, 4, 5 times? Royalty companies a lot better. ASX last year was running, this is of consensus forward earnings, ASX last year was running 15.5, 16? So already there is massive potential uplift in terms of that risk appetite. Sovereign risk, mostly talking about avoiding it, not managing it. And when it comes down to the emerging aspects of these big institutional funds, they're putting a whole new perspective on ESG, environment, social and governance. It used to be about social license to operate in our host communities, and that has now all shifted, transcended to a universal obligation or a universal ownership, where these institutional funds will take a 5-bagger plus ESG over a 10-bagger every day.
Thanks, Mitch. Was that only 5 points? And I'm glad I said only one more question, and I hope you got your deposit back for the microphone there too, Sam. Thanks for the question, Mitch. I'm just going to direct a couple there to the panel before we wind up. And the panel will end with a one-liner prediction from each of them, just about how they see mining financing going into the short-term future. But I think the things which came most strongly from your questions there, Mitch, which we hadn't really addressed, was the environmental, social licence to operate, etc. Could you guys maybe just give us a quick one each? And Aaron, I know banks are very concerned about this stuff, so maybe you lead off just quickly on, is that as important as financial returns?
Yeah, it's over the period of time that I've certainly been in financing this industry, it has grown in importance more and more and more. I mean, a classic example would be within our organisation, we have an Ethics and Responsible Business Committee, and generally for projects that we bank in this industry, we have to go to that committee, and quite often it can be more rigorous debate around the potential risks that sit around ESG for some of these projects, and more active debate there than there is around looking at credit risk. So it's seen as it's fundamental now to banking the projects and actually looking to support these projects. Absolutely fundamental.
Jason, social licence to operate. You know the world probably much better than I do and most of the panel, the world over.
Yeah, it's fundamental both on entry, on operational, and on exit, right? When buying asset from a mining strategic, they want to know we can operate and have a focus on ESG. When we're operating, we need to deal with communities and the environment. In Matave, in Indonesia, we had 60 people in the environmental and community department. And big investment, but worked very well. So, I think financial returns and ESG really go hand in hand. And our investors, which includes pension funds, endowments, have a big focus on ESG too, so it's very, very pervasive.
Richard, rather than social licence to operate, maybe you could deal with, I'm not sure if it was the 11th or 12th question there, which was around miners get together for liquidity and relevance. Do you think bigger is necessarily having to be better in the current market, or do you think that the growth appetite of some of the bigger companies and their consolidation appetite has shifted?
Yeah, look, I think it goes back to a point I'd made earlier, that it used to be the leapfrog, bigger was innately better. We used to have lots of theories around companies trading at a premium relative to other companies because they were bigger, and that was the answer in itself. I think that's not the case at this point. I think people are much more strategic about how they go around doing transactions and what drives them, genuine synergies, sometimes it's about scale, sometimes it's a balance sheet meeting, coming together with a project that needs the funding. Sometimes it's about a thematic play. It's not just about scale. I understand the point around institutions wanting liquidity and scale to be able to get in and out of a business, but that sort of leapfrog thinking, which is simplistic, wasn't the point really being made, but that scale for scale's sake, we don't really see that.
All right, look, that is all the questions that I had, and that's all the questions we'll take from the floor. But can I get you all just to finish, and I'll limit you to one sentence here, otherwise you're going to have to buy some shares in a company of my choosing. I would just like one sentence on your view on the outlook for mining finance over, say, the next 3 to 5 years. Jason.
We are positive on mining finance, for future decades. Growing capital, but more specialized.
Excellent use of commas to break that sentence up. Aaron.
Good projects with good management will be banked, but the key to funding from a bank perspective is to engage us early and treat us like a partner.
Also an excellent answer. Richard, last words.
I'm under pressure. I think the small caps will be fine for funding, listed markets will be fine for that. There's a semicolon in here somewhere. But I think that the mid caps are going to be vulnerable around this funding question, and you'll see consolidation, balance sheet needs driving some of those trades.
Gentlemen, thank you very much for your contribution to the discussion panel, and particularly with light to the events which sadly took place yesterday with the passing of our patron, Sir Avi Parbo. He valued people who got to the crux of the matter very quickly, which is a behaviour which he showed himself. And I think we can all pride ourselves on how quickly you've done that and for your interactions. Ladies and gentlemen, will you join me in thanking the panel whilst the MC comes back up to the stage? Thank you, Rebecca.
Well, thank you, Hedley, and thank you to our panellists. Members and guests, we now do have the opportunity to thank our panel and our moderator, and it's my honour to propose that vote of thanks for the insights that everyone has shared with us today. But to join me, I would ask Joel Rennie, the partner from White & Case, and Andrew Hall from AMC Consultants to help me with that vote of thanks and the gifts that we have to give each of our panellists. Come through. There's nothing like giving a miner a hammer.
Thank you. Thanks.
Thanks.
Yes, thank you.
Oh, is that right?
Now, ladies and gentlemen, we wouldn't be the same Melbourne Mining Club lunch without the opportunity for me to spruik a few of our upcoming events, and there are flyers on your tables. I've heard so much conversation, I'm not sure